Welcome to my channel. I'm Scott, and in this video I'm going to walk you through the process of valuing McDonald's stock by analyzing their financial statements and dissecting their financial ratios so we can determine if it's a buy or a sell. Let's get started with the model. This is a large cap company, 197 billion market cap. They're trading at $2.73 a share, and they have 722 million shares outstanding. McDonald's is the world's largest fast food restaurant chain, serving over 69 million customers daily in over 100 countries. They have more than 40,000 individual outlets. Their biggest seller is French fries, followed by the Big Mac. Their revenue comes from rent, royalties, and fees paid by the franchisees, as well as some company-operated restaurants. It is the world's second largest private employer. The largest is Walmart. It started as a hamburger stand and later turned the company into a franchise. The Golden Arches were added in 1953. In 1955, Ray Kroc, a businessman, joined the company as a franchise agent, and in 1961, he bought out the McDonald's brothers. McDonald's is a huge real estate company. They own 70% of the buildings and 45% of the land beneath the buildings. Let's look at their financials. The way you value a company is you estimate the free cash flows into the future, and then you discount those numbers back to today's value. That's what we're doing in this video. And free cash flow is cash flow from operations minus capital expenditures. They do have a lot of free cash flow each year. It was $4.6 billion in 2020. It jumped up to $7.1 billion in 2021, a 54% growth, down 23% in 2022. Up 32% in 2023, a solid $7.3 billion. Really good margins. They converted 28% of their revenue into free cash flow in 2023. Free cash flow per share is $10. The way you calculate that, it's free cash flow over shares outstanding. Net income is the profit or loss on the income statement. It's revenue minus expenses. And that almost doubled from $4.7 billion to $8.5 billion. Really solid margin, 33%. Revenue is a sales for the company, and that goes up from $19.2 billion to over $25 billion. Revenue per share is $35. They pay a 2.4% dividend yield, a payout of $4.8 billion, which they can easily afford. They have over $7 billion of free cash flow. We estimated 4 years of future free cash flows. We also estimated the terminal value, which is all cash flows, past year 4, that's $211 billion. We discounted those numbers back to today using the weighted average cost of capital. We get a value of the company of $187 billion. We divide that by 722 million shares. And we get a calculated stock price of $2.59. They're trading at $2.73, so they're trading at a 6% premium. It's a sell according to the model. There are 60 companies in the same industry as McDonald's, and if they have a number in red, they're worse than the median. If they have a number in blue, they're better. They spend almost the most in CapEx, a little under $2.3 billion. Starbucks spends the most, a little over $2.3 billion. We can't look at their debt to equity ratio. They have negative equity. They pay a good dividend, 2.4%, a little less than the median. They generate the most free cash flow by far. Almost exactly the same number as the next three companies combined. 4.5 plus 1.3 is 5.8. 5.8 plus 1.3 is 7.1. So the next three combined are about 7.1 billion. They're 7.3 billion. They're the biggest company by far, the size of Starbucks and Chipotle combined. Can't look at their price to book since they have negative equity. They're trading at 23 times earnings, a little worse than the median. 27 times free cash flow, a bit worse than the median. About 8 times revenue, a lot worse than the median. They generate 25 billion of revenue, second to Starbucks. Their 5-year annual revenue growth rate is only 4%, so they're not growing as much as other companies in this industry. They've done a lot of stock splits. The first one 53 years ago, a 3 for 2. The following year, a 2 for 1. Then a 3 for 2, a 3 for 2, a 3 for 2, and a 3 for 2. Look at all these stock splits in the 80s. Then 3 2 for 1s. It's been 25 years since they did a stock split. If you invested $10,000 into McDonald's 10 years ago, and you reinvested your dividends back into McDonald's, you'd have $35,000 today. That's a 13% annual return, which is probably better than the market. Let's take a look at their financials. They're going to release their first quarter earnings in a few days on April 30th. Their latest financials are as of 12/31/2023. This is the income statement. It shows us 2021, 2022, and 2023. On the top of the income statement is revenue, top line. 23 billion, 23 billion, 25.5 billion. They give a little breakdown of the revenue. Almost 10 billion from company operator restaurants. I didn't realize they generated that much revenue from their company operator restaurants. I thought it was mostly franchisee royalties, as well as rent. 15 billion from franchise restaurants. US revenue is 10.6 billion, international revenue 12.4 billion. They also get 2.5 billion from international development licenses. Even though their US revenue is less, it's around 40% of their revenue, their operating income is almost identical in international and US. So their margins are much better in the US. They're spending a lot more internationally. Their CapEx spend is 1.3 billion. US a little under 1 billion. CapEx is the investments in property, plant, and equipment. When they buy the real estate for a store, that's part of CapEx. Let's go back to the income statement. Below revenue is the expenses. Food and paper, 3 billion. Payroll, almost 3 billion. Occupancy, 2.3 billion. The cost for their franchise locations, 2.5 billion. Other, 230 million. Depreciation is right here, 380 million. Other, 2.4 billion. Total expenses, 14 billion. Operating income, 11.6 billion. That's up a lot from prior years. They paid 1.4 billion of interest on their debt, 2 billion of taxes, net income 8.5 billion, up more than 2 billion from last year, up 1 billion from 2 years ago. EPS 11.63, dividends per share 6.23. So they pay about 60% of their EPS in dividends, and their shares are going down, 746 million, 736 million, 728 million. That's what you like to see, shares going down, a company buying back stock, plus they give you a dividend. You can't beat that. Let's take a look at the balance sheet. Current assets, 8 billion. Current liabilities, 7 billion, so they have a current ratio above 1. They have 4.5 billion of cash. It was 2.5 billion last year. Accounts receivables, 2.5 billion. This is when they sell on credit. 3 billion of goodwill. Their largest asset by far is PP&E. They're one of the largest holders of real estate in the world. 44 billion of PP&E. Here's a breakdown. 7 billion of land, 20 billion of buildings and improvements. Those buildings sit on land they own. 13 billion of buildings and improvements. Those buildings sit on land they lease. And 2.7 billion of equipment, signs, and seating. Their gross value is 44 billion, and they depreciate 19 billion. So the carrying value is 25 billion. That's the value on the balance sheet. Total assets 56 billion, up from 50 billion. Their biggest liability is long-term debt, 37 billion. They also have 13 billion of long-term leases. Lots of debt. Assets minus liabilities equals equity, negative equity, because their assets are less than their liabilities. And the reason they have negative equity is they buy back so much stock. They bought back 75 billion of their own stock. Treasury stock is a contra equity account. It brings down your equity. It also brings down your cash because you usually use cash to buy back stock. You can see they're very profitable. They retain earnings of 63 billion. And additional paid in capital is how much money they raise from selling stock, 9 billion. Let's take a look at their statement of cash flows. The first section is operating cash flow. That's how much cash they generate from running their day-to-day business, 9.6 billion. That's a lot higher than prior years. And the way you calculate operating cash flow, you start with your net income, 8.5 billion. Then you add back the non-cash items on the income statement. You add back depreciation of 2 billion. Then you adjust for changes in working capital. It looks like they extended some credit, so that's a cash outflow of 161 million. When those customers pay for that credit, it'll be a cash inflow in that accounting period. They spent 2.4 billion in CapEx. CapEx is in the investing section. They purchased 441 million of businesses, probably restaurants from their franchisees. They sold 195 million of restaurants. These are probably McDonald's they bought from their franchisees and are reselling them to other franchisees. Sometimes a franchisee is not doing well, or just maybe they can't run the business anymore. Maybe they got sick, maybe they died. And McDonald's takes it over instead of shutting it down, operates it, and then sells it to another franchisee. They sold 95 million of property. That's a cash inflow. Let's look at their financing section. They added 212 million of short-term debt. They added 5.2 billion of long-term debt. That's a lot of debt. But they did pay down 2.4 billion of long-term debt. They bought back $3 billion of stock. It was almost $4 billion last year. They paid $4.5 billion of dividends. That's higher than prior years. And they received $260 million from people exercising stock options. In their financing section, they had a cash outflow of $4.4 billion. Last year, a cash outflow of $6.6 billion. It was better this year because they added more debt. They added $2 billion more debt this year than last year. And they added $4 billion more than 2 years ago. Their long-term outlook is 50,000 units by 2027. Wow, 50,000 McDonald's. That's an average annual run rate of 1,000 restaurants. Let's look at the stock on Simply Wall Street. Its last price, $273, $197 billion market cap, up 0.5% in the past week, down 8% in the past year. Let's see what they say about the company. They operate and franchise restaurants under the McDonald's brand in the US and around the world. It offers food and beverages, including hamburgers and cheeseburgers, chicken sandwiches, fries, shakes, desserts, sundaes, cookies, pies, soft drinks, coffee, and other beverages. Also breakfast and limited time promotions. They operate a franchise model. They also do licensing and affiliates. They were founded over 80 years ago in 1940, based in Chicago, Illinois. Here's their stock price since 1990. It was as low as $6 a share. In 1999, it was close to 50, then dropping to 13 in 2003. From 2003 to 2020, it went up a lot, over 200. Then the COVID crash, down to 130s, and then it's mainly been up since then. There was some dips here and there, but the stock has done pretty well since COVID. It's currently in the low 270s. On 2-1, it was close to 300, but the stock probably moves with the market. Simply Wall Street's valuation is $267. They say the stock is 2% overvalued. 31 analysts priced this stock at $320. They say it's really undervalued. Here's their revenue forecast, $27 billion for 2024, $28.5 billion 2025, $30 billion 2026. Their free cash flow forecast is even more bullish, $8.8 billion for 2024, $9.3 billion 25, $10.5 billion 26. Their revenue was really high in 2013, almost $28 billion. It's been pretty much coming down year after year until 2020, falling below $20 billion, but it's coming back up at $25.5 billion, still lower than 11 years ago, which is really interesting. This red line is their debt, which goes up year after year. The blue line is their equity, which seems to be going down year after year. $40 billion of debt, negative $5 billion of equity. And this green line is their cash. They don't keep that much cash on their balance sheet relative to their debt. Here's their dividend since 2014. It was over 3% back then. Now it's around 2.5%. The forecast for 2026 is 3%. The CEO's salary was $675,000 in 2017, up to $1.4 million currently. Total compensation $19 million. Tenure as CEO 4.4 years. This guy has a Harvard MBA, which does not impress me at all. In the past year, no insider buying, just lots and lots of selling, as you can see here. About 8 million insider shares have been sold in the past year. That is not a good sign. 71% of the company is owned by institutions, 28% by the general public. Their biggest shareholder is Vanguard at 9.5%, then BlackRock, State Street, Chiodo, Wellington, JP Morgan. Berkshire does not own McDonald's directly. Their subsidiary, New England Asset Management, owns them, and I don't see them on this list. Their employee count was 440,000 in 2013, down to 100,000. They used to operate a lot more McDonald's, but they're operating less and less and franchising more and more out. The ticker trades on the New York Stock Exchange, Swiss, Mexican Bolsa, Deutsche Börse, Xetra, Santiago, EuroTLX, Wiener Börse, Bulgaria, Santiago, BATS Europe, Buenos Aires, Sao Paulo Bolsa, and the NEO. So let me know what you think. Give the video a like, subscribe, or comment below. If you'd like to get a custom valuation or just support channel, you can become a member of